Eddie Ghabour is Key Advisors co-owner and managing partner, joining us now with so much driving these markets. We've got earnings season underway. We've got vaccine news. I want to start with something you pointed out, which has to be whether or not this is a good time for an investor to buy equities. And I'm curious, if you were going to buy, can you give us specific stocks? And if not, are there sectors that you find more attractive in these uncertain times?
Yes, I think right now, look, I do expect short term for us to see some downside pressure as this stimulus bill, I think, is probably going to stretch out till August and may make investors nervous. But I think this is a year where markets just aren't going to trade on fundamentals. So we have to throw fundamentals out the door, unfortunately, short term. So I would focus on the growth plays that have become more of your defensive stocks like Amazon, like Microsoft, like Apple. In regards to a recovery story, I still like the housing sector. I think the housing sector has got some nice upside as we're in this low interest rate market environment. But again, Wall Street is not trading on fundamentals right now. And the question is, are we in a 1995 beginning of a bubble, or is this more of like a 1998 towards the tail end? I'm more worried about 2021 versus I am the rest of this year, because there's too much cash on the sidelines. The Fed is continuing to pump liquidity, and it's an election year, so they're going to continue to throw as much money at this as they can, but that's not going to continue forever. And when that stops, the question will be is how will the economy handle growth without stimulus?
Eddie, I want to back up for just a second, because I think it's kind of intriguing, your idea that the likes of Apple and Amazon are defensive stocks right now. What would change that, do you think? If indeed fundamentals don't matter, is it that the Fed is offering stimulus and so we'll keep on seeing these stocks go up until that changes?
So I think it's a combination of two things, because, looking at these growth stocks as defensive plays obviously is outside of the norm. That's not going to change until we get a vaccine and people are comfortable taking that vaccine and the economy goes back to normal. Because right now, the stay-at-home economy and working from remote, and schools maybe not going back on time, that's here to stay for the rest of this year, which plays right into these companies, which is why you've seen the multiples expand and investors continue to pump more money into that. And then, of course, yes, the stimulus. I mean, when this stimulus does stop, that's going to be the million-dollar question, is which sectors are going to be able to hold up on their own. And again, I think if you look at these technology companies, they do have great growth, pretty good balance sheets. So that's why when you're seeing down days, you're actually seeing these stocks hold up better than most of the market.
Hey, Eddie, it's Brian Chung here. Great to chat with you again. Now, on one hand, we've been talking about equities, but it seems like the bond market has been telling a slightly different story, right? We haven't necessarily seen bond yields continue to go down as the stock market has continued to rally. Now, you can argue to what degree is that because bond yields are already so close to near zero, and also because of the Fed's intervention. But what are you gaining from the fact that the 10-year right now has kind of been hovering around 60 basis points or so over the last week? Is it telling you that maybe the flight to those risk-on assets maybe is a little bit overblown?
I think that is what the bond market's telling us here in the near term, because I think as earnings start to roll out, it's going to be very choppy. You're going to see some good earnings reports and you'll see others that really struggle, which is why I think right now the bond market is telling us they don't have as much confidence in the growth of the economy here in the last 2 quarters of the year as maybe the equity markets are pricing in right now.
Eddie, I am curious, continuing that question from Brian on bonds. I know we're talking about equities, but as an investor, would it be foolish for me to try and look at gold? I mean, right now, gold is over $1,800 an ounce.
Look, I think gold right now is actually a great way to diversify a portfolio. So as an investor with the right risk tolerance, I think it would be prudent to add gold, because again, unless you think this market, this economy is going to be a V-shaped recovery straight up, I think gold will continue to do well, because as we open up over the next several months and going over the next 12 months, it's not going to be a smooth ride. And I don't think it's a V-shaped recovery in the economy itself, no matter what the market does. So I think gold could do well for investors right here.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.